Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for April 5th of 2021. Please see our disclaimer for important information. Well, as we commence the chart pack of the week, we start with our COVID tracker, which is produced from data provided to us by the CDC and compiled by First Trust Advisors, our friends up in Chicago that helped to compile some of the charts that you'll see in the coming slides. But as we look at the data this week, amidst the backdrop of several states, prominent states, including Texas, that have kind of reopened their economy to 100% capacity, you can see that the daily 7-day moving average of positive cases is ticking back up ever so slightly. Again, it's coming off the trough at the same time that we see a continuing moderation in the 7-day moving average of daily deaths that are being reported. And I think what we're seeing here is a byproduct of increased vaccination trends, and we've got some slides on that. But at the same time, reopening is kind of testing us a little bit. And, we've got several little, I guess I'll call them incubators, if you will, or experiments out there. We know, just as an example, that the only Major League Baseball stadium that is going to be open to 100% capacity is Globe Life Park in Arlington, the home of the Texas Rangers. And so it'll be very interesting to see what happens in that particular geography based on that reopening, where most of the other facilities in the Major League Baseball and frankly sports in general are still operating at limited capacity. So we have several dynamics going on, but the positive thing is that we're seeing a continuing moderation in daily new deaths. Here's a quick snapshot of our approved manufacturers under emergency use authorization. Continue to see mass vaccinations utilizing the Pfizer, BioNTech, as well as the Moderna vaccines. Now, J&J is a one-shot regimen as opposed to the other two that I just mentioned, which are two-shot regimens. And we now have 3.3 million doses of the J&J vaccine, which have been administered. Now, all told, we're up to 150 million doses administered, and some of those are folks like me who have received our first shot but not our second. But we are continuing to make progress. It is going to, help us in this reopening, help us achieve herd immunity, and everything that we've been talking about in these charts of the weeks, as well as our market minutes, my sister program to this, for many, many, many months now. Here's a quick snapshot I thought that was interesting to look at. So this is cases per million versus plotted against the vaccinations per day per million. And so, the areas that you might imagine that have, total cases per million population that are relatively high, like the US and Israel, have also been leaders in vaccinations per million. And you can see that there's a clear divergence from both Israel and the US to the rest of the pack. Now, most of you have been reading in the news that Europe is lagging behind. That's very true. You can see Germany and Italy, France, Sweden in those red colored, well, Sweden's more Scandinavian, but certainly France, Spain, Italy, and Germany are lagging behind fairly considerably, even though in some of those areas they've had a fairly high caseload per capita. Got a lot of data on this chart, but I love the data that comes out of Oxford Economics, as well as the overlay of data that they get from the CDC. And then on the right-hand side, which is really interesting, is this is basically a track of if we continue at current trends, what will happen to the vaccination of the population. And I thought this was really, really telling. We've been talking about how we feel like, we'll have enough doses to inoculate everybody in this country by the end of May. And I still feel that we're kind of tracking along that line. And so, if you look at the right-hand side, you can see this trajectory. This is at the current rate. You'd have 75% of the population would be vaccinated by June 27th. And so that gets us to herd immunity. So whether it's the end of May, the end of June, it's kind of in that time frame that, that we're looking at this so-called herd immunity concept but we've been doing a relatively good job of inoculating people in certain areas. And it's possible that you could reach that mark by the middle of June. And so if we're sitting here literally days into April, that's not a long ways away. And that doesn't mean that we can all take our masks off and do, everything that we once did, but it gets us a lot closer. And it's kind of a medically important level of inoculation that allows us to really open the economy in earnest, not just in certain areas, but broadly speaking. Now, on the left-hand side, you've got your, in your blue, you've got first doses, red is the second dose, and the share of the population over 18, which has been inoculated, in that green trend. And so, again, if you get June, you've got 55% in the Oxford Economic Study. July is 71%. But the share of receiving at least their first dose is exceptionally high, and much higher. When you get to June, then you're already looking at 80% having some inoculation, even though it may not be their full 2-shot regimen. But you do see a lot of traction. I think there's a lot of data, a lot of research, which is kind of coalescing on this thought that in that June timeframe, we can really begin to to analyze and begin to plot this broad reopening, which people are anticipating greatly right now. So this is information, again, from Worldometers, which provided us some information in that last chart. Also CDC and Census Bureau, but this is kind of looking at historical pandemics and putting the 2020 coronavirus into perspective. And so you can see here that, obviously the 1918 flu pandemic was massive in scale and in proportion. And if you haven't read anything about the 1918 pandemic, I would highly suggest that you do that. It's a fascinating read. I couldn't imagine what it would be like to be alive during that time, and how sensitive and scary and anxious the people might have felt based on that trend. And they don't have half of the social media. Well, obviously they didn't have any social media back then, but half of the capability of transmitting news that we do now. But nevertheless, it's still a very high death per million for the 2020 coronavirus relative to some of the other ones that we've seen, particularly the 2009 swine flu, which many of you might remember. It was communicable, but it wasn't terribly deadly. 1957-58 pandemic got a lot of publicity, and it was a real situation, as well as the 1968. But you can see that the 2020 coronavirus is certainly more relevant in terms of death per million than either of those two. Now here's our First Trust high frequency data monitor. And what I can tell you about this chart is we're looking at it right now is it's perhaps the most positive, the most consistently encouraging set of data in this particular data lineup that I've seen in a long time. Not only are you seeing progress in most areas over the last week, but over the last month as well. I think this is a very consistent theme that we're seeing in all of these areas. I mean, we've got more airline capacity being committed to the market because TSA checkpoint data is up significantly. The sale of motor gasoline, we've got more vehicles on the road, more traveling going on. People are going to work, going to the office a little bit more. We've got more table reservations at restaurants because we've got more reopenings that are occurring. And then we've got more travel in general. So RevPAR, which is revenue per available room, and hotels going up, daily rates going up, occupancy is going up. And we know we've been talking about from the production side, even though prices are going up in much of the manufacturing channel for cost inputs for cost items that are essential to as a part of production. But we have shipments of steel, rail car traffic, all positive, box office receipts where more movies are being shown. So this is really, really positive. And we are seeing increased traction in the labor market, which is also another positive. I saw this in the first trust package, and I thought this was really interesting. And in fact, it's exceptionally compelling here. This is basically a survey by YouGov on feelings by population age cohort on their interest level and being able to socially interact after the pandemic. Let me underscore after. And what was profound to me was, and I expected actually the very opposite of this, that the younger age cohorts actually feel somewhat nervous about the social interaction. And these are the folks that, probably medically have less to fear because the deaths per capita in those lower age cohorts is infinitesimal relative to the upper age cohorts. Yet the upper age cohorts are tending to, at least in this survey, not feel terribly nervous at all. So this is data that actually surprised me enough to the point that I was motivated to put it in the chart pack this week. But if you stare at this, it really, I think that the read through, I don't know, maybe it's not a read through, but maybe the implications are that, obviously the upper age cohorts are the ones that tend to do a lot of the large spending. So perhaps that means that that's not going to be impacted that much. The lower age cohorts that may feel a little bit more nervous about social interaction, maybe they don't do as much, maybe they're not spending as much, maybe they save more. I think it's really too early to tell, but I would love to corroborate this study with other surveys, and I pay a lot of attention to the Pew Foundation and some of the Pew Research surveys that are done, and so I'm very eager to see other data which might corroborate this. For all my school teaching friends and friends in the education community, I found this actually particularly interesting too. And again, no state is alike when it comes to reopening the schools amidst the pandemic. You can see Florida, Georgia, Iowa are the ones that are most open to in-person educational content delivery. And then you've got the states on both coasts, which are much more reluctant, recalcitrant, whatever the adjective you want to use is, but to reopening. And so obviously there's a very strong divergence across the country on states reopening their schools. So now we'll transition into a lot of data. I've got a lot of charts, so I'm going to try to be efficient with my time and just kind of lay out the data. Here we've got an inflation kind of read through. Again, energy is a part of the CPI, and it's not a part of the core CPI, which strips out food and energy, but you can see energy prices are going back up. Crude prices are moving higher. That's resulting in higher gasoline and other distillate prices like kerosene and fuel oil and things like that that are cracked, if you will, from petroleum. So those prices are going higher, and that's going to influence the CPI, even though it may not have done that yet, which this core CPI, which doesn't include energy, is relatively flat. You can see that, it's changed modestly year over year. It's in that yellow or that orange bar, I guess, if you will. And then you have the ISM, which is the Institute for Supply Management Manufacturing Prices Paid on the right-hand scale. And that's that gray line. And this is something we've been talking about for weeks, that these input prices that manufacturers are having to pay are going sky high. And so at some point, and we're monitoring this. So at some point, you're going to see that transmission effect of intermediate prices within the production channel be passed along to the end buyers, the end consumers, whatever that end market is. And so I think these, if you look at energy and you look at manufacturing prices paid, you see that this is going to have an influence particularly on the ISM manufacturing prices paid, is going to have an influence on inflation here in the next 6 to 12 months. So here's some data from PIMCO, which I thought was interesting. This is their view of inflation expectations. And it breaks it down into the core CPI, which is, everything that the CPI has, or the headline, yes, and then the core, which, as I mentioned previously, breaks out food and energy. And you can see here that the headline inflation number with all of those cost inputs, the manufacturing prices paid, the energy prices going up, you can see that in their estimate as we transition into the second half of this year that we're going to see a spike in that inflation. And that's kind of that piece of the transition that the Fed kind of says, well, this is transitory. This is, the kind of this inflation bump that we're going to get because the economy is reopening in earnest with vaccinations and things like that. But it is inflation nonetheless. But in their view, you're going to get a bump in both the core inflation as well as a headline inflation. Now, I would agree with this chart that the effects of energy prices and cost of production, they'll kind of mute out, I think, year over year. Once we anniversary this bump from last year and we get a lot closer to 2022, you'll see less overall inflation year over year, which I do think is true, but it's still going to be a little elevated, I think. And particularly as you look out into the end of 2022, I think you're just going to see higher inflation. That's what the bond market is telling us right now. But that's not necessarily a bad thing. As I've said repeatedly over the last several weeks, the world can operate just fine with a little bit more inflation as long as it's not outsized and as long as it's not kind of a real short-term bump in unexpected inflation. So this is a chart that coming out of a massive dislocation in the economy, you kind of those dotted lines would be kind of what you'd expect to see. But I think the key thing to take away here is that where we are or where we anticipate we're going to be at the end of next year, which is what, another essentially 21 months away, more or less, we're going to see a higher inflation regime than we do now. So this is something that ties back into inflation. And we've been talking about this as well. So in this orange, you see real rates. This is basically the 10-year Treasury rate minus inflation. And so as inflation has picked up with rates remaining low, we've had negative real rates. And so there's a lot of implications for this. It's been driving more assets into, or more liquidity into, asset inflation for stocks and whatnot. And for a while, it was really helping the gold market quite a bit. But you can see here in the black are the long run inflation expectations. And we've been watching this, and we know that over the last 6 to 9 months that inflation expectations have been going up. We've talked about producer prices going higher. We've talked about energy prices moving higher. Those are all very valid dynamics into what the market is expecting in terms of inflation looking out over the coming months. And so with that, we've seen higher rates and yields have moved higher in expectation of higher inflation because it is a very causal type relationship. And with that, we've seen some rates that have increased faster than we've seen the inflation, and therefore we've seen some moderation in this negative real rate environment, and as a result we've seen gold kind of take it on the hit. We have a chart on gold coming up, but what's interesting is that as long-run inflation expectations move higher, we will eventually get rid of this negative real rate environment, I believe, and we'll transition to a positive real rate spread. Now let's talk about the labor market for just a second. We've got some updates, I think, fairly intuitive to most of you that have been following our charts of the week and market minutes that know that, we're on a positive trend with regard to labor. But there's a couple of important dynamics here at work. On the left-hand side, we've got this chart, which is the U3 and the U6 unemployment rate. And what in the world does that mean? That is, the U3 unemployment rate is the headline rate that you see reported every month by the Bureau of Labor Statistics. The U6 rate, which in this chart is basically that black line, and that represents the folks that would like to be fully employed, that are working part-time, but they're not satisfied with working part-time. They would still like to have a full-time job, so we call them underemployed. And so if you look at both of those, those numbers have come down. We've had, there's a lot of research, which is not worth delving into here, but you know, when you break down the socioeconomic layers, you know, you have very high unemployment rates for the lower income, and unfortunately for some of the minority components of the population. But overall, you see that number continuing to trend down. And so the Fed has said, as part of their dual mandate, which includes stable prices and full employment, that they're going to be watching not just this chart here, but also the components that make that up. So they want to make sure that all of the socioeconomic layers are benefiting from this positive employment trend. Now, obviously, we've got a long way to go to get to where we were, but we are making progress. Now, on the right-hand side, we have the participation rate. This is the labor participation rate. And usually when you have a large economic dislocation like we had last year, you have a lot of folks that just leave the workforce. And if they leave the workforce for a long time, they become less employable and need retraining and things like that to be able to get back in the workforce. And what we've seen is that we've had recovery in participation. Again, you know, if you think about the labor force in this country, the difference between like a 60% and a 63% represents millions of workers. So this is important. So we've had recovery, but we've not had a full recovery, and we've actually kind of stalled out a little bit, if you will. So there's folks that have essentially millions of workers that are out of the labor force that have not yet come back in. Some of them are waiting for better opportunities. Some of them are frankly waiting or maybe anticipating having to be trained to be able to re-enter the workforce. There's a lot of different reasons why labor participation rates are sticky, but it's important to realize that, you know, I think this represents both a constraint and opportunity, in the sense that, you know, it's hard for us to achieve a true full employment number when you've got people that are out of the workforce and not participating. But at the same time, if you've got people that are outside the labor force that might be making job hiring a little sticky for employers, it could actually drive wages up. So we've been watching this figure as well, and this is basically household net worth as a percent of their disposable income. And you'll see in a second that, you know, we've got some comments as far as like household balance sheets, which have really improved. And so household net worth, if you include the value of one's home, which is typically for most Americans going to be their most valuable asset, but also you have an increasing number of individuals who own financial assets like stocks, and those have gone up. So you've seen a real spike of household net worth in the aggregate, but also as a percent of disposable income. So even if you assume that income growth has perhaps stalled a little bit, if you will, or maybe growing at a slower pace than it has, the fact that we've got a lot of folks out there that are achieving a higher net worth relative to their income is a real big positive. This number helps to feed into consumer confidence. It helps to certainly feed into spending. And I think that sets the stage for a positive environment for all the consumer-related data points that we follow heading into the fall. This is something that has been intuitive. We've talked about this a lot. It's been this divergence of goods versus services spending. And obviously, you can imagine that if you're in a pandemic and you can't have a lot of face-to-face interaction, that there's a lot of service industry and a lot of service related spending that's not going to happen. Restaurants, hospitality, travel, so on and so forth. But goods have been exceptionally strong. I mean, everyone that I know probably in a 3-house radius has, bought appliances or constructing things, and so their goods buying has really perked up here, and you can clearly see that number is well above where it was pre-pandemic, and is likely to stay higher. What that has done, actually, though, is created a problem in the production channel, and it's created bottlenecks in production. It's created bottlenecks in sourcing materials, and we've had a huge clog in several of our main ports, the port of Los Angeles and Long Beach, one of the largest ports in the world. You've got container ships that are backed up waiting to get into port. And that's just one example of many that I could cite where you've got real choke points within the supply chain. And so you've got essentially an environment where goods demand is picked up much faster than the supply chain could support. And so that's driving prices higher at the consumer level. Again, this will feed into consumer inflation at some point, but you're also seeing higher prices in the production channel, and you're seeing long delays in actually sourcing things. I think somebody told me if you wanted a Chinese made dishwasher or washer and dryer, you might be on a 7 to 8 month backlog right now, which is just profound. But that being said, if you look at the number that sits below that, which is a services line, and that number is picked up here. It's kind of flatline, but as we see more openings and we get to this herd immunity, we get to this environment that we were just talking about in June and July, I think we're really going to see that number begin to migrate higher. Maybe not as close to the goods line, but it'll migrate higher, and it'll be very positive for the second half of this year. This is the Bloomberg consensus estimate for GDP, and this is essentially the estimate of GDP as it's kind of progressed from basically this time last year. So if you think about March of 2020, being just the awful environment that it was, most people thought that the 2021 GDP, the economic growth rate, would be about 2%. Well, as we reopened after that first initial wave, those estimates went higher to about 4%, which they roughly kind of stuck around at that point until we began to see the first quarter earnings reports by these companies. And then now we're expecting a fantastic year. I mean, a truly amazing year in terms of economic growth. It's very rare that we will ever see a 6% economic growth. But that is now where we are in terms of the expectations, up from 2% 12 months ago to 6% now. Thought I'd throw this chart in because I've been watching a lot of data points related to liquidity in the system. This is a pretty important one. So you've got private equity that has a lot of cash on its balance sheet, a lot of dry powder, as this chart on the right suggests, available to make deals, to acquire companies. You can see the number of tech acquisitions by private equity firms has just blown through the ceiling this year in the first quarter. I mean, a fantastic number of acquisitions done by private equity, and they're not done by any stretch whatsoever because there's so much liquidity that they hold. So again, you could see purchase multiples go up because there's a demand for acquisitions. You can certainly see, companies that need liquidity that are willing to give up an ownership stake, be able to achieve that liquidity event to help support their growth. So, I take this as a positive, as there's a lot of liquidity in the system that's trying to find the highest and best use. And so a lot of this liquidity is kind of migrating its way up through what I'll call, in some respects, kind of the shadow banking sector, and it's finding its way to company balance sheets. And I think these two charts bode well for not only tech valuations, but I think overall market valuations as well. As you're going to have a demand for equities, you're going to have a demand for acquisitions that's going to continue to fuel and really be a ride side saddle to this economic recovery that we expect throughout the rest of the year. The quick comment on the household situation. So we alluded to this earlier. So on the left-hand side, the household leverage ratio just basically tells you that households have improved their balance sheets. They whittle down debt, home values are going up, and people have refinanced their mortgages. So debt service levels have gone way down. You can see on the right-hand side, savings have gone up, and we know that some of that is due to stimulus payments. And that's okay. Checkable deposits are actually through the roof right now. So we have a lot of household liquidity, and household balance sheets are in really good shape. So what do I take away from this? So you've got a lot of liquidity that people are hoarding right now. And I'm not saying that they're going to keep it, but if you go back over the last several years on this right-hand chart, you can see that they haven't had this liquidity. This is very unprecedented. And so the question is, what are they going to do with it? And usually when we see high consumer confidence like we have now, it eventually translates into consumer spending, which is 2/3 to 70% of the total economy. And so these two charts give me great comfort in the ability of the consumer to take 2 steps forward and assist with this recovery. And I think these are 2 charts which really help to kind of reinforce and support this notion that we saw a couple charts ago, that expected economic growth this year is going to be close to 6%. And I think that's actually a very reasonable goal. So here I've got a chart of household net worth. And so this is kind of the last of these household charts that I wanted to show you. And obviously there's been a lot of influences on this, home prices, assets, things like that. You can see that, we really are in rarefied air in terms of household net worth, and it just adds to this power of the consumer. So a quick note on our debt situation as it stands right now. With this $2 trillion package that we just got for stimulus, the infrastructure plan, which has just been announced, and I won't go into that right here, from the Biden administration. So you've got a lot of borrowing going on, basically, and I say in some respects some profligate spending, but it's clearly stimulative. And you can see both the Federal Reserve balance sheet, which is just basically blown out over the last year, as well as government debt outstanding. And so this is something, and I've got some Congressional Budget Office charts to show you in a second, that shows you that chart on that right, that ascension is going to continue. That rise is going to continue to migrate out. And they're just broad implications, which are just a little hard to get your arms around right now. Is it going to lead to inflation? We don't know. Is it going to lead to curtailments and forced curtailments and entitlement programs? We just don't know. But this is just a really profound increase in government debt that we've seen to help fund these stimulus programs. So here is that chart from the CBO, the Congressional Budget Office, which shows you where we are. If you look at that dotted line that kind of plots where we are now, the pandemic, we showed you in that last chart that we've had that spike in government, in federal debt held by the public as a result of some of these programs. But, the CBO is really charting kind of a pessimistic path here. They're expecting by 2051, again, this is a long ways away, but I remember when we were sitting here at, Y2K, and just like, seems like we've gotten here in the snap of a finger, but, another 30 years down the road, I mean, we could very well be 200% of gross domestic product, which, I mean, puts us at a point that, really not too many countries are, have that level of debt per GDP, and certainly debt per capita. This is kind of a summary of why we see that divergence and that increase in debt, because we've got outlays per the Congressional Budget Office that are expanding faster than revenues. And if you take out the spike in outlays related to the pandemic fiscal programs, there's clearly more spending that's coming down the road. And so revenues continue to be flat. And this is the real conundrum for politicians right now, is that you've got outlays. Some of these are scheduled outlays that are indexed, that are going to go up, whether you call the kettle black or not. But then you've got the challenge of raising the revenue to meet that, and you can tax so many different constituencies to the gill. You can tax the rich, you can do a lot of things, and still not cover this ground. And this is the real conundrum that future leaders are going to have to reconcile and deal with. This quick chart on deficits, this really dovetails with the last chart in the sense that the expectation, at least from the CBO, very clearly is that we're going to have increasing deficits over time. But some of this is going to come by virtue of net interest increase. And this is the other thing that I think is worth kind of keeping in the back of your mind right now, is that we have had low interest rates. A lot of this debt that was issued, this federal debt that was issued last year, exceptionally low interest rates. But now we've got interest rates moving higher, and so the government has to sell, the Treasury has to sell debt into a competitive market, and there's a very orderly process amongst prime dealers that takes place. It's essentially an auction environment. So the Fed has to pay market rates to sell its treasuries. And so, the increase in those rates is going to be obviously an increased federal budget concern, and that's going to contribute to our deficits quite a bit as we tread into the next 15, 20 years. And here's a quick chart on federal net interest expense. This is right now, the average, or I guess a percent of nominal GDP right now is only about 1.5%. And there's some estimates that we could retrace where we saw when we, back in the 80s and early 90s, that it could be as high as 3%. You think about where does where is that? What are the implications of that difference going to be if you've got federal net interest expense going up essentially, another 1.5 to maybe even 2% as a percent of the total economy? So as a result of inflation and all the other stuff that we've been talking about, we've seen longer term rates rise. In fact, now we see a fairly strong, like 90% consensus amongst institutional money managers that the Fed will raise short-term interest rates by the end of next year because of this froth and inflation expectations that we're seeing, but it's driving longer-term yields higher. And in fact, I would surmise, looking at this chart, that we have really the healthiest, most normalized looking yield curve that we've had in a long time, and that's because longer term rates are moving higher and short term rates are still kind of anchored low. I view this as healthy. It's better for savers, not as much for borrowers. Obviously, this is the 2 to 5 year government bond spread, and the 2 to 10 year, with 10-year treasury rates moving higher, has more of an implication for mortgage borrowers, where mortgage rates are now moving higher, kind of the 30-year fixed over 3% on a very consistent basis right now. But again, I think a better overall, a higher spread on short to long-term rates is good for banks. I think it's better overall for the economy. I think it's symptomatic of an expanding economy, which I think we're seeing in a lot of different data points. So on balance, I take this as very positive. But the flip side of having rates move higher is that you have price erosion in bonds, especially long duration bonds. And we have clearly seen that. In fact, we have had one of the most difficult quarters in the fixed income market that we've had in a long time. I mean, where bonds have been down more than 4% in one quarter. And of course, that breaks the traditional mold that you buy bonds to mute the volatility of the equities in a kind of traditional 60% equity, 40% fixed income portfolio. And that obviously went the other way. And I think, and you'll hear this consistently, I think we are on the precipice. I really do believe at this time that we're on the precipice of a changing in interest rate, that long since 1982, we've been a secular bull market in interest rates where both inflation on an average annual basis as well as interest rates have moved down over time. And I think we have moved down to such a point that we've now troughed and we're beginning to move higher. And obviously we're in a new inflation cycle, I believe. And so that's going to keep fixed income returns fairly muted right now. So I'm not necessarily looking for a lot of increased negative returns in the fixed income market, but I think it's going to be more challenging than it has been, where investors have received a lot of their total return in the fixed income market from price appreciation, and I think now that has gone away, and we saw a big kind of a revaluation, if you will, in bonds here in this last quarter. A couple of other interesting data points. We know that things like semiconductors. We've talked about the supply chain, and some elements have been really hard to find. We know the semiconductor market is really clogged up and backlogged right now. So there's a difficulty in finding in getting new cars to market, but there's a demand for it. And we know that consumers have a lot of money and they want to spend it. So interestingly enough, we've seen a huge spike in used car values over the last several months. And as well on this comment about sourcing, supply chain, whatnot, obviously, even though we're in a trade war with China, and I think a lot of the sanctions and tariffs remain in place from the Trump administration, that there's still a lot of trade between the U.S. and China. And here, there's very clear evidence that the sourcing from China is coming at higher prices. In fact, by this chart that comes to us from the St. Louis Fed, I mean, we're seeing some of the fastest price increases, the most robust price increases that we've seen for products coming out of China since 2012. In this chart, we have high yield bond spreads. This is a continuation of a trend that we've seen, but we've seen some exceptionally low bond spreads. This chart right here is very symptomatic of a high yield bond market that's not concerned about credit defaults, not concerned about a downturn in the economy, but rather very optimistic in every respect about the recovery, about credit quality, about the ability for issuers to make good on their payments to investors, et cetera. What's interesting here, and I've talked a lot about the fact that we really missed this credit default wave that we were anticipating last year. I thought that we would see it. It would blow spreads out in the high yield market. It would cause a lot of bankruptcies and so on and so forth. And we really haven't seen that. But in this chart from JP Morgan, it's clear that we have seen an increase in defaults. And so it's, I don't mean to minimize, as I've been talking very conspicuously over the last several months over this notion that we didn't have a credit default wave like we expected, but we have had credit erosion in certain areas. And you think about, the lagged effect of some issues. We had a lot of energy firms that were really struggling last year. And frankly, couldn't get out of the cash flow pickle that they were in, and finally had to declare bankruptcy, or they defaulted on their high yield notes. And I think we're seeing kind of that that lagged effect, if you will, here both on, in this chart, you have senior secured loans, which are secured by assets of the corporation, as well as, general high yield bonds, which are, which are bonds and issuances of companies that are less than investment grade. So a quick comment here on return attribution for the S&P 500. And as you can see here, if you look at 2017, 2018, that blue area, that most of the return in the S&P certainly for 2017 came as a result of earnings. Now, in 2018, we had kind of multiples contract, but that was offset to some degree by earnings, even though we had kind of a negative year. 2019 was a banner year. We had a lot of multiple expansion, a lot of enthusiasm, a lot of liquidity running into that market. And then 2020, we actually had earnings that were off, not nearly as much as people thought because of the pandemic, but they were negative nonetheless. But as a result of having lower earnings, that price to earnings multiple went higher, and we wound up having a lot of multiple expansion, and the market went up big time, just as it did in 2019 when everything was working, all cylinders were firing. Now this year is interesting because, I can't say that we've had multiple expansion like we've had in years past, but we have had a pretty outstanding earnings year thus far. Just again, it's the first quarter, so a lot can happen between now and the end of the year. But we've clearly had a strong earnings environment, and earnings estimates are moving higher at a pretty astounding clip. And there's a lot of expectations being built into the second half of the year for the S&P 500 earnings. Well, not to throw cold water on things, but I thought I would share this from B of A, and I just love their quant group. Savita Subramanian has been at Merrill Lynch for a long time, and she's phenomenal. But this is a simple plot, a line of best fit, if you will, basically a plot of normalized price to earnings against the subsequent year annualized, or excuse me, subsequent 10-year rather, annualized returns. And so this is telling you, where you are in terms of price to equity ratios and what that means looking ahead 10 years. So if that makes sense. So where we are, we're about on a normalized PE basis, we're, by their work, about 25 times. Overall PE, if you don't normalize, it's a little bit less than that. The cyclically adjusted PE ratio is probably in this is in this neighborhood. And so this line of best fit with all of these plots dating back to 1987 would tend to suggest that we're going to have a fairly muted return, something below 5% over the next 10 years. And if you look at this line, there's a fairly high, this R squared, which is an indicator of the power, predictive power of this chart with these many data points. And if we're 2021 and we're basically 1987, I mean, that's a lot of data points to draw from. So I think this is fairly consistent amongst the analysts' expectation. I would also concur that we should go into financial planning with the assumption that perhaps we're not going to see the same equity level returns that we have in the past. But I think that's being conservative. Now, there are outliers to this, and it's not to say that we are locking ourselves into a lower return regime for the next 10 years. It just says that the data, the line of best fit would tell us to be more conservative in our estimates going forward. And with the market that we've seen here lately, I thought it was really interesting to kind of look at fund flows. These are exchange traded fund flows that trade on the equity markets. And you can see here from a factor standpoint, earlier last year, coming out of the pandemic, kind of in that, the middle of the summer, we saw a lot of fund flows actually we saw them in 2019 too, into quality stocks. Now that number's kind of rolled over a little bit, and in turn we've seen a lot of money move from kind of momentum into value at the same time that we've kind of seen this low volatility trade kind of go away, which is interesting because I think, we should be protecting against volatility more so now than ever. But really the trades that I think are really interesting to me is that investors have bought into this notion of increasing their value holdings, which are firms that tend to be more cyclically exposed when the economic cycle improves. And I absolutely agree with that. But at the same time, decreasing your exposure or your interest in lowering your volatility at the same time is perhaps maybe a little symptom of being a little optimistic in this market. Gold, as we've been discussing, has been retrenching. The negative real yields have kind of dissipated somewhat. That's taken a little bit of the froth off gold. We're kind of looking at kind of longer term, maybe a resistance point here. Yeah, I'm not expecting a whole lot from gold. I do think it kind of holds its head here. This is an important technical level for it to hold, but again, I'm not looking for a lot of outsized growth in gold. The dollar, I thought this was kind of an interesting chart. As a reserve currency, I don't think the dollar is going to be displaced anytime soon, but I do see here in this chart from Bloomberg that it's becoming a little less relevant than it has in past decades. And so what's replacing it, likely the euro in some cases. A lot of people have speculated, is the Chinese yuan going to step up? And I really don't think so. It's probably the euro, if anything. And it'll be interesting to watch what happens to this chart if the dollar continues to lose share as a reserve currency. And that's what really gives us economic power across the globe. And so I would really hate to see this number migrate too much lower. And I would say that we would like to end on a positive note, as we've been talking about this synchronized global expansion. This is a chart that really speaks directly to that. So export, this is basically an indicator of trade. The composite indicator is in that kind of purple line. It's moving higher to a large degree. These are global numbers. Even though we've got vaccine delivery issues in Europe, and a lot of other places in the world, especially in third world markets, we're still seeing a lot of trade. And where we had seen trade kind of erode really over a couple of years with the tariffs and things like that were being promoted, and the kind of the constraints to trade that were being imposed, this is a clear signal that is, even though some of those tariffs and things like that still remain, that global trade is really picking up, and that's a huge, huge positive looking ahead into 2022. Well, that's all I got today. It was kind of heavy on the chart pack. I appreciate you hanging with me. Hopefully it was interesting to you, that you learned some things from it. In behalf of my entire team of colleagues here at BKA Wealth, we really appreciate you taking the time to spend time with this chart pack, and we welcome your feedback. I hope you have a safe week, a productive week, and to those of you celebrating Easter, I hope you had a wonderful Easter weekend, and I look forward to talking to you again soon.